Well, our next guest says U.S. stocks could grind higher from here, but a lot will depend on the upcoming second quarter results and guidance from big U.S. corporations. And he says there's still a risk that inflationary U.S. tariffs could push the U.S. economy into recession. Let's talk about all of this with Amit Joshi, portfolio manager at Barometer Capital Management. Amit, thank you very much for joining us. Let's first of all talk about what you expect to see and hear and what you think markets want to see and hear from the second quarter earnings releases in the U.S. that are not too far away right now.
Hi, Paul. Thank you so much for having me on the show. Yeah, when we look at markets for second half of this year, we're very constructive. We think we're still in the early innings of a bull market. Generally, when you look at historical figures, dating back to 1928, your typical bull market lasts about 59 months, and markets generally advance about 178% during those timeframes. This current bull market is about 32 months in duration and has advanced about 73%. So we're overall constructive. We understand that the multiple on the S&P 500 is higher than it has been historically, but we do feel, what we saw for the last earnings period, very constructive results and forward guidance. So we are looking for about 5.5% earnings growth on average from U.S. companies from the S&P 500 for Q2 earnings. And, we'll be dialed in on guidance from management teams, especially given impacts of tariffs and how the management teams are navigating those waters. But overall, we feel constructive. When we look at our positioning for the second half of this year, we feel comfortable with the exposure that we have. And, with tariffs, there is the potential that they're inflationary and could lead to a recession. However, we don't think that that's something that's imminent at this point. When we look at the data, that doesn't seem likely, especially, we've never seen a U.S. recession with corporate profit growth being positive year over year or without any rise in the unemployment rate. So those two aspects do give us a lot of confidence.
The first quarter earnings season was one in which many corporations suspended their forward-looking guidance, citing economic uncertainty. And now, as you know, one of those companies, Delta Airlines, has come back to providing forward guidance, and it's fairly robust, saying that in its industry, passengers are coming back, and they're renewing their efforts to book travel, both personal travel and business travel. And in fact, the CEO uses the phrase, customers are becoming somewhat numb to tariff news. Do you expect more big companies to resume providing forward-looking guidance?
Paul, I think that's an excellent point. And I think, we have seen a ton of headlines in terms of tariffs. President Trump has been laser focused on this, especially since the passing of the budget bill. And it'll continue to be something that's in the headlines for sure. I do feel he's given a bit of an off-ramp in terms of talking about, negotiations even after, the August 1st, the July 9th deadline or the August 1st deadline, whichever date he continues to kind of push that out to. So I think there is an off-ramp. I think that gives, even when you look at the underlying market, the VIX, which is the, measure of volatility of the market, is trading around 12-month lows. We've seen North American indices continue to grind higher in the face of all this tariff talk. Delta's guidance, I think that's a positive. So I think, the expectation here is that maybe we do get some trade deals and maybe those tariff rates come in better than headline expectations. Given we've seen that from Delta, I think the expectation is as there's a bit more comfort around tariffs, we will start to get more kind of formalized guidance from companies and management teams going forward.
Okay, let's talk about some stocks that you like. One is Cameco, the uranium giant, based, of course, in Saskatchewan and trading in both Toronto and New York.
Yeah, we continue to see, a lot of momentum building globally for the nuclear industry. And, we have seen head fakes in the past. However, I think it's encouraging when you see the EU being more supportive to nuclear, Belgium reversing some nuclear phase outs. We've seen, just even in the United States itself, executive orders being passed to encourage domestic industry in terms of nuclear. And we think Cameco, being the largest publicly traded uranium producer, really fits in well, not just from a uranium production side, but what's really interesting is their Westinghouse Electric business, which they own a 49% stake in, the other 51% owned by Brookfield. This is a very strategic asset for Cameco. They're a global leader in nuclear reactor technology, and their core nuclear services provide support for about 50% of the current globally installed base. And that's massive. Cameco recently upped the EBITDA guidance for that business, and we continue to think that that business will benefit from this inflow of activity in the nuclear industry.
The stock has almost doubled, or perhaps even more than doubled, since that first week of April, when so many stocks and market indices broadly took off. But this one has really gained since early April. It has essentially done the double. Would you be a buyer of Cameco at these prices?
We continue to buy, just not from where we are currently, but where we think the company could be in the next 5 to 10 years. We do think the nuclear build-out is in the early stages here, and it will be at the forefront of energy transition and energy security going forward. And like I mentioned, Westinghouse just being such an important asset for the company and the amount of work that we expect them to get, we think this is a good setup for Cameco going forward.
Okay, another stock you like is GE Verona, one of the GE breakup companies, GEV, on the New York Stock Exchange.
Yeah, this is another company that fits in well with the power theme. Like you mentioned, a spin out of GE. This is their energy business, gas power, electrification, nuclear as well. One thing that's clear is on the back of the AI data center boom, the amount of power demand is going to be incremental, and ultimately the demand for gas turbines has been very, very robust. This company has a massive, massive backlog. At the end of Q1, sitting at about 76 billion. 45 billion of that in equipment sales for those gas turbines themselves. We have a lot of great revenue visibility here. EBITDA margins were expanding year over year from 8.5% to 11.5%. That's on the back of increased productivity and really strong pricing and volume growth. They recently instituted a 25-cent quarterly dividend and been buying back shares. And while the stock has had a really strong rally here on the back of the gas turbine orders, I think what's underappreciated is the upside potential for longer-term service contracts for those gas turbines. So we think that's an underappreciated part of the story, and that could provide another leg up in the future. Let's
go back to a Canadian stock, MDA Space, the aviation and aeronautics specialist.
Yeah, MDA Space is an interesting company here in Canada. We think we're in the really early innings of the space economy and the monetization of that space economy. They operate 3 verticals: robotics and space operations, satellite systems, and geointelligence, sitting on a very massive backlog as well, multi-year revenue visibility, some very strong partnerships with the likes of Telesat and Globalstar, and a company that just very financially disciplined, clean balance sheet, generating positive free cash flow year over year. They have a new facility in Quebec that's been ramping up nicely and should help with efficiency going forward and just scale in a growing market, which is important. They recently had a very strategic acquisition of SetXFi, which is a manufacturer of satellite chipsets. We believe this is a really good acquisition for the company. There'll be benefits from vertical integration, and it also provides them a key sourcing of a component for their products that will benefit them going forward.